All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com, and there you can download my free ebook where you can learn the basics of options trading. And also, if you download the free ebook, you will be put into my email distribution where you'll start receiving my weekly newsletter that comes out every Monday at 10 a.m. Eastern Standard Time, where I talk about various topics, but primarily economics, finance, cryptocurrency, and also, of course, the stock market, obviously. And also from time to time, I give stock investing recommendations and also crypto investing recommendations as well. So you definitely want to be a part of the Cubicle Weekly readership. All right, so today is November the 17th. It is Thursday. It's approximately 4:35 p.m. Eastern Standard Time. So that means the market is closed. Right, so I want to talk about a couple of trades that I put on today. Today was a pretty easy trading day. I mean, I must say, so let me just start off by saying when the market closed on yesterday, November the 16th, the closing price was $39.58. Now, if you guys have been watching my videos, you know that one of the first things I do, I look at before I put on a trade is I look at the previous day's closing price. And then I look at for today is November 17th. So what was the expected move for today before the market opened? So before the market opened, the expected move was plus or minus 41, right? So essentially, I just add 41 to yesterday's closing price, and I subtract 41 from yesterday's closing price. So that gives me a potential upside of $39.99 and a potential downside of $39.17, right? So those are my points of reference that I look at when I'm determining which strike price I'm going to select for my vertical credit spreads, whether they be on the put side or on the call side or both sides, right? So when the market opened today, let me just clean this up. So when the market opened today, it actually gapped down. It gapped down roughly 40 points. So it opened at 39.19 is what I have written down. I can easily hover over the this 5-minute candlestick here. But yeah, it opened at 39.19. So right out of the gate, the market gapped down close to roughly 40 points. And so if you've been watching my videos, you know that on average, the market moves roughly between 50 to 60 points per trading session. Now, can it move more? Of course it can move more. But I'm saying on average, it moves roughly 40 to 60 points, right? So the fact that right out of the gate, right when the market opened, it got down 40 points, to me, that conveyed, hey, this is going to be an easy trading day potentially, because all you got to do is go on the put side and go down a lot further than where the price gapped down. So what I did was I went just clear this out here. So I sold a vertical put credit spread at 38.50 and 38.45, and so I got into this trade like right after the market opened. So I got into this trade at 9:31, right? So 1 minute after the market opened, got into this trade. Sold 4 contracts. I should have went a lot bigger, because to me this was an easy trade. Yeah, and so I got into that trade at 9:31 a.m. and the market eventually. Now, one of the things I want to mention is that, oftentimes when you see a large gap like that, what the market has a tendency to do is to fill that gap actually, during the actual trading session. Sometimes it may take a day or two, but oftentimes you'll see that the price will come back and look to fill that gap, right? So the gap being the closing price on the previous day and today's opening price. And as you can see here, the price eventually, it got close to filling the gap, but not quite. But nevertheless, it basically followed the conventional wisdom that, when you have a gap down or gap up situation, during that same trading session, the market, the S&P 500, has a tendency to fill that gap, right? So knowing that, in addition to the fact that I was well below the expected move, I felt pretty confident, you know, and so I was able to actually get out of this trade early. I normally don't close out my trades early, but sometimes it's prudent to actually close out your trades early because you never know what may take place, what may transpire throughout the market. So I actually got out of this trade at roughly 11:48 a.m. So I was in a trade for 2 hours and close to 20 minutes. Right, so I closed that out, and then, you know, went on about my day, came back later in the day, so roughly around 2:52, so roughly about, let's see, about here, right? So roughly around this point here, I got into another trade on the call side this time. So I was on the put side at first, and I put on a vertical call credit spread, and I went, let me just see here if I can remember. Oh yeah, I have it here. Yes, I made a quick 120 bucks, so roughly $300 in total today. I sold the 39.60 and I bought the 39.70. So I sold the 39.60 and I bought the 39.70. As you can see, you know, the price started to bounce late in the day, but nevertheless, you know, I felt pretty confident that it wouldn't reach my my short strike of 39.60, and so I was successful in that trade as well. So yeah, it was a pretty easy trading day. You know, anytime you get a major gap up or gap down, particularly if it wasn't the result of some crazy news, and considering the fact that the market moves roughly 50 to 60 points on average per trading session, you know, you can always go further, you know, if it's a gap up, go further above the expected move and maybe add 30 points to your short strike. Or if it's a gap down situation like today, you know, you can go well below the expected move as long as the credit makes sense. You know, you don't want to be put it on a position where you're only getting $15, you know, for a credit. You want to at least get, you know, from my perspective, you want to get at least 35 cents or $35, because we know that every option contract controls 100 shares. So 35 cents really is $35. So you want to get at least 35. Ideally, you want to, you know, get as close to $1 as possible. But nevertheless, oftentimes, you know, the bigger the credit, not oftentimes, but, you know, the bigger the credit, you know, the more risk you're taking, because you have to get closer to the price of the underlying to get those really, you know, meaty or fat credits, if you will. So yeah, so again, today was a pretty easy trading session. So hopefully you guys are learning something from watching these videos. And if you haven't already, please subscribe to the channel and like the video. I'm trying to get to at least 250 subs by the end of 2022. So definitely help me out. If you haven't already subscribed to the channel and like the video.